Hi, this is Larry Lane for InvestorZoo.com, and I just wanted to touch on portfolio diversification and asset allocation. Before we get started, I am not a registered investment advisor. Please do not make any investment decision based upon what you hear in this video. Always consult a professional before making any financial decision. So that being said, if you're an investor, you have a lot more decisions and a lot more asset classes to choose from today than you did even a year ago today. So let's go over those classes. So you have large, mid, and small caps. Large caps being the Caterpillars, the Alcoas, the General Electrics of the world. These make up both the S&P 500, which is the largest 500 companies, as well as the Dow Industrial Average, which is the top 30. There's also the second asset allocation class would be mid caps, which are $1 to $10 billion, which might be a company like a Ross Stores. And you can buy a mutual fund and an ETF for all these asset classes that I'm mentioning now. The one of the matching indexes for the mid cap would be the ETF MDY. And if you wanted either the Dow Industrial Average, where you could just match the market, match the Dow, it would be DIA, or SPY for the S&P 500. Stocks with a market cap of $300 million to $1 billion are known as small caps. This index matching would be the S&P 600 or the Russell Small Cap 2000 Index. The closest matching ETF for that would be FSLCX. Stocks valued at $300 million or lower are considered microcaps. Microcaps are the smallest of the small and considered the most illiquid. That being said, if you do your homework, you can make a considerable amount of money on trading small and microcap stocks, since they're not covered by a lot of investors and a lot of analysts. There are positive and negative effects to all of the asset classes that are listed. Small and micro-cap stocks tend to outperform large caps over a number of years. However, large caps do provide a little bit more consistency, and they do usually pay some type of a cash dividend. Small and medium companies tend to take whatever money they have and reinvest it back into the company. So why not just invest all of your money in small cap stocks and just be done with it, since they outperform large caps on a long time basis? The answer is you never want to put all your eggs in one basket and just consider putting everything into small caps would not be the smartest idea. Reason being is that over a long period of time, you will achieve a higher rate of return by spreading your asset classes around a little bit more than you would if you just went for the small and micro cap stocks. Suppose you were to take a 50% hit, and just if you had $100, take a 50% hit in your portfolio, which has happened to the small and mid cap arena for several times during the last 20 years. Your next year you would have to double just to break even. By spreading around your risk a little bit more, you will achieve a higher rate of return. Within the small, mid, and large cap arenas, there is a value and growth. Growth company might be a company like Google. Value company may be a company like GE or Caterpillar or Alcoa. A large company which has been established for a number of years and not knocking the cover off the ball, but still a good solid company. Over a long period of time, value has outperformed growth. Warren Buffett and Benjamin Graham are considered to be the fathers of value investing. So with the world in flux, you might consider that you may need some foreign investments just to, again, spread your risk around a little bit more. Much like U.S. stocks, you can invest in just about any company, go small, medium, and large in that company, go growth or value within that company. You can currently invest in a large variety of different currencies through ETFs, and just to further complicate things, you can invest in just about any commodity you want to through ETFs. So you can, um, suppose if you wanted some gold exposure, instead of buying gold coins and paying $20 or $30 a month in storage fees, you can just buy an ETF, a matching ETF. Just one of them would be GLD. You can also invest in silver, corn, sugar, coffee, you name it. There is just about an ETA for everything. So if you're feeling a little bit overwhelmed, totally understandable. You might want to look into hiring a financial advisor who can determine your proper risk and your proper asset allocation. Um, by investing in a mutual fund or an ETF that matches your particular index, such as an index fund over an actively managed fund, um, you'll be getting long-term peace of mind knowing that your manager is not going to blow out your account and uh, possibly experience a very, very big downturn or do something stupid like all their eggs in one basket, which has happened. That being said, if you do invest in an index because of expenses, these companies are in it to make money just like everybody else. You will never beat the index that you're trying to match. So for example, if you buy the SPY or if you want to match the S&P 500 index, you're always going to lag that index by percentage points or fractions of a percentage point because of expenses. Where index funds make sense is to get that proper asset allocation, and through diversification, through your ETFs or your mutual funds, you may be able to beat the S&P 500 or the Dow over a number of years. So investing can be complicated. Make sure that you have a written plan before you do anything, especially if you're long-term. Stick with it. You're always going to hear those things that buy and hold is dead. You should be trading the market. There are very few people that can consistently beat the market on a day trading or an actively trading basis, which is why the majority of long-term investors are in mutual funds and in particular index funds. So you might want to check out a book by Vanguard funder Jack Bogle. He's got some great anecdotes and some great statistics backing up his viewpoint that every long-term investor should be invested in index funds versus actively managed funds. But again, that's up to your individual preference, and if you're going with a money manager, their individual preference. There are some periods where actively managed funds will beat index funds and vice versa. Just remember, your fund, if it's actively managed, is only as good as the individual manager or the group of managers that are, the people behind the fund. So this is Larry Lane for InvestorsZoo.com. If you would like to check out some of our additional blogs, or you would like to post one of your own, whether it be a money savings or investor tip, hit us up at InvestorsZoo.com. Thanks and have a good rest of the day.